Chris, thank you very much for joining us today. How are things in Toronto?
Great, James. Thanks for having me. And yeah, things are good. Snow, powder, can't complain.
So there is so much happening in Canada right now, and our federal government is in a total state of disarray. We also have a potential trade war coming up with the US. We have a new administration in the US that wants lower taxes and higher tariffs and also deregulation and deportation. Some people say these policies will be inflationary, other people say it will not be. And then you also have the uncertainty with the last Fed meeting that we had in late December, where the Fed came out and they gave us a view that they might cut twice in 2025 versus their previous expectation of cutting three times. So on the back of that, we've seen a lot of uncertainty and a lot of volatility in the markets. Why don't we just start right here with the bigger picture? When you look at the U.S. markets, the S&P and the NASDAQ, what are you seeing? What are your views?
Yeah, so I think there's a lot of kind of layers to this onion. There's a lot that's kind of going on in the markets, a lot of mixed signals, which is why I think so many people are nervous. There's a lot of uncertainty. It's why we've seen gold, I think, do well. But uncertainty continues to climb. So when we look at the big picture, let's kind of look at the big kind of weekly view of the market. So the first thing as investors, we need to understand we're going to be in a bullish or rising tide environment, or we're going to be in a bearish environment, a falling tide. You don't want to own equities. And we are still in a bullish environment. Now, the market has sold off a little bit in the past couple of weeks. Short-term wise, we've exited the market. Long-term investment wise, should still be long this market. So that's kind of where we are. We're in a rising tide environment and having a little bit of a market correction. Now, if we look at the SP 500 here, there's an interesting scenario unfolding here in terms of cycles. I'm big into cycle analysis, and pretty much what we've seen during all of these standout lows, these specific standout lows, is a cluster of multiple different types of cycles coming into play. And it's hard to see, but it's at the bottom of my indicator, these red boxes. These are times where the market resets. And we have to exit the market because we think the markets potentially could continue to sell off. You never know how far a market is going to fall. So if it starts a downtrend, we get out. Now, where we are right now in terms of the market, we're having a short-term downtrend. Right now, the market is putting in this kind of a cluster, a cycle low, and we are in a long-term bullish phase. As I just showed you, James, typically dips can be bought and the markets want to go higher. My analysis shows the SP 500 could rally about 5 to maybe 7%. The NASDAQ could rally maybe about 11% from here. So this to me is like icing on the cake. I think it'll be like a free trade, a bonus trade. I don't think the markets are going much higher than that. I feel like if that happens, it's again just a once-off opportunity. I do feel like in the grand scheme of things, this market is going to be going a lot lower this year. I think the major market is putting in a top, and the long-term scenario of what is happening right here in terms of money flows in different asset classes is the same we saw over here. Money is starting to flow away from equities. It's starting to break down, and so I'm very neutral to, neutral on this market. It could go either way at this point. We just need to see which way things are going to flip here over the next week or two, I think.
And I just want to clarify one thing. When you said the market can lift 5 to 6% on the S&P, and I think you said 11% on the NASDAQ, at that point, do you see it topping out and then we see a significant pullback?
Yeah, I think that could be what we see. Very similar to over here. You poke into it just a nominal new little high. Everybody gets really bullish one last time, and then the market tanks and falls.
And what sort
That
of
that
pullback would you anticipate percentage wise?
Yeah, percentage wise. So if we use a Fibonacci retracement, which is a great tool to gauge how much of a pullback should happen, we can gauge this whole this whole rally here, and how much the pullback could go. So roughly, let's just go from these highs over here. I think we could see about potentially a 16 to 20% pullback would be the first really sharp pullback in the markets. From there, it'll have some type of bounce. So that there is quite a bit of downside potential from the market. I mean, this is the most conservative play right there, and current price of the market is right about here. So it's about a 12% from where we are, and that's a really critical pivot point in the chart based on this pivot low and this noise and consolidation through here. And of course, it's also a 38% retrace back. That's typically the first level that stocks pull back to and bounce. So there is quite a bit of downside and not as much upside potential here going forward.
So one of the reasons why we've seen this pullback in the last few weeks is because of the commentary out of the Fed. The
Mm.
economy is a lot stronger than people had anticipated. And so therefore, we're not going to see the same interest rate cuts that we thought we were going to see. But why don't we take a look at the interest rates right now, the 10-year bond or whatever chart you want to look at, just to get an idea of what's happening here.
Yeah, if we take a look at the 10-year note, it's definitely showing signs of strength. I think the best way to show this is kind of the monthly chart. Obviously, we've had a 40-year decline, falling interest rates. Now the tide has turned, and believe it or not, this is a very, very bullish chart pattern showing that interest rates could continue to keep going higher. And a lot of people aren't expecting that, but this is showing huge upside move. And I don't think a lot of people want to be around for this, but we could see like 8+ percent on the rate, which would be obviously devastating probably for the stock market. For real estate, things could get really ugly. But overall, we are seeing this hold up really well. If this does continue to happen, the bond market, like TLT, the long-term treasury bond ETF, is going to continue to fall and continue to struggle. Now, when we look at this monthly chart, it has been in a bearish pattern for a long time. It's showing signs of increased volatility. It has what looks like could be a signature of three surges to a low. So one, two, and then potentially one more big drop if interest rates go up. And three surges usually triggers a massive reversal and it can change the tide in a whole new direction. So it's going to be very interesting to see how this unfolds. Um, I think bonds are going to be a good play at some point, but right now you're really just it's a high risk play, and there could be another very big down leg. If rates go up, this is going to go down dramatically. So,
Chris,
uh,
do you mind going back to the interest rate chart that you had up there?
yep.
Because what I find very interesting here is that I recently had a discussion with an economist, Juliet de Klerk, and she thinks that she sees the same sort of thing that you do, except her analysis is based on an economic analysis, and she thinks the Fed has lost control of the long end of the curve, and we're going to see the long end of the curve go significantly higher. The Fed and the Treasury are not going to be able to do anything. The Fed is got the short end of the curve under control, but they can't do anything about the long end, and so therefore what's going to happen is the Treasury or the federal government is going to have to finance trillions of dollars of debt at a much higher interest rate, and this is going to put a lot of stress on the U.S. economy. So
Yep.
it's going to be interesting to see how this plays out in the coming months.
For sure.
Um, so that is the what you think is going to happen with interest rates. Why don't we take a look at the U.S. dollar because all of these components are interrelated. So I want to see the
Mm.
US dollar has been very strong. It was up, it's trading at or near all-time highs against the Canadian dollar. I think the Canadian dollar lost about 10% against the USD last year. It's at a 22-year low. What do you see here?
Yeah, I think the US dollar's got another big leg up. I think typically when we see chaos in the markets, like the 2000 financial crash, we had the 2008 financial crash, financial reset. I think we're going to see, a big leg up here on the next move. We've got rising lows, higher highs. The dollar's channeling up, and I believe we're going to continue to see this move up. And this is going to strengthen, obviously, the dollar, and it's going to wreak havoc for a lot of other currencies. When we look at all these other currencies here, the dollar has been moving up very strong compared to all the other currencies. And so this is going to cause a big problem, I think, even with U.S. companies, multinational companies who deal across, around the globe. The U.S. dollar is going to become so expensive that they're going to have to like cut their pricing, cut their all this stuff. It's going to hurt sales, and it's going to really cause a lot of problems with earnings. And of course, that bleeds over to layoffs and cost cutting and all kinds of stuff, which creates this whole snowball effect or adds to the whole kind of, I think we're seeing a global recession take place. So bullish on the dollar. I think this will put pressure on commodities. It'll put pressure on a lot of stuff temporarily. Um, but I think the dollar is a low volatility, bullish move. It's a way to take advantage of chaos without having to be like in something really volatile.
And you and I both reside in Toronto, so why don't we take a look at the Canadian dollar versus the USD?
Sure, yeah.
This exchange rate is killing me now. I can't even afford to do a trip to New York.
I know it's
I'm paying a
wild.
40% premium for
Yeah.
restaurants and hotels and
Yep. So looking at the US and Canadian dollar, like right now, one US dollar is $1.43 for us Canadians. Very expensive. Based on this chart and based what I think is unfolding, I think we're going to see oil break down, which means that the Canadian loonie will fall in value. I think we're going to see the US dollar go up, which means it's going to create this huge spread. Based on this chart pattern, I think we could actually see about a $1.74 exchange, which is like enough to make most people cringe. Canadians, you're not going to want to go to the States to go on holidays anymore. So there is potential for some huge moves across the board. And I mean, this is what happened in the tech bubble, the financial crisis, oil going to zero not that long ago. Anything can happen. And I think this year is going to be a year of just stuff will be like, wow, I never knew that could happen. It'll just be another one of those years. And the key is of being able to identify and navigate these so that you can come out unscathed or hopefully with a lot more money because there's ways to take advantage of all of these plays. So I would expect the US dollar to go up. And if you own equities or own real estate in the United States, it's a real trade-off. There's a great exchange rate. It might go a little bit higher, but liquidating and going to cash, holding US dollars is a really good play because if you think about it, if real estate is going to crash and you own US real estate, I'm looking from a Canadian perspective, sell the US property, you go to cash, but keep it in US dollars. The US dollar is about to rally like 20%. And then once all chaos hits and the dollar spikes up, cash out of the US dollars, move to Canadian. And I think the Canadian dollar will rise from the ashes. I think it's going to come down to a resource kind of move, and we're going to see resource heavy currencies like the Canadian dollar become a powerhouse and come back from the dead and allow you to grow your wealth really well. So there's some really good plays unfolding here.
And Chris, one of the reasons why we're seeing a lot of weakness in the Canadian dollar is because of what's happening here within the country. And the Canadian economy is very weak, in spite of the fact that we're neighbors with the US, which is the strongest economy in the world. It continues to grow at 2.5 to 3%, but our economy is very weak. And maybe you
Mhm.
can just talk about that and where you see what are your views of the Canadian economy and where you see it going in the coming months.
Yeah, I mean, I don't have any Canadian data, but I do feel like Canada and the United States follow pretty similar patterns in terms of what everything is doing. I mean, job openings have been falling. When we look at unemployment rate, it has been going up. Even though there was a little pullback, it really means nothing. It's just a one piece of data. We actually saw a little bit of a hiccup for a few quarters just before the 2008 financial crisis, where unemployment took off. So I think we're in the same boat. I think Canada is a little bit weaker, as you said there, James. But the overall picture, generally, the United States, North America, we all kind of move as one. One might lead the other a little bit, but I think we are on the cusp of seeing things slow down. We're going to see, I think, real estate market get hit very hard in terms of real estate pricing. If we take a look at real estate pricing, I think single family homes are about to fall off a cliff. And that is going to, a lot of investors are going to tighten their wallets. They'll be like, wow, my house property just fell like $300,000 in value in the last, 4 months. And they're going to see the stock market start to go down. And that's going to close people's wallets. They stop buying. Businesses, where's that chart? Pull it up here. Businesses start trimming back labor because sales slow down because everybody tightens their wallets and unemployment spikes. So what happens in the States is going to happen in Canada or vice versa. We're all kind of one. I generally follow US data just because there's more of it. Don't know if it's more accurate, but there's more of it.
And in terms of real estate, everywhere I go, I'm seeing for sale signs in Southern Ontario. What are your thoughts on real estate?
Yeah, yeah. I mean, this is a really good chart. This is the same in Canada. This is the pending home sales. So during COVID, when no one could really buy a house. Pending home sales fell to a record low. And here we are with just natural markets doing their things. No one is buying homes. And that's why we have this huge surplus of homes right now. We've got, um, you know, hundreds or, well, in my town, there's hundreds, almost 700 homes for sale that aren't selling. And that really is based off this. There's a lot of people putting homes up for sale, but they're not selling because no one wants to drop their price and be like, oh, I don't want to drop it and go below market value. Meanwhile, nobody's selling because market value is below all of their current pricing. And nobody wants to be the first one to be like, oh, and get called like, oh, you gave your house away, right? But once that starts, we're going to see this. And Canada, I think, is definitely going to see a more severe pullback, I think, simply because we got mortgages coming up for renewal. We've got 3, 5, 7 year mortgages. The 5 years are going to be coming up here, and people cannot afford the mortgage rates. In fact, again, this is US data, but look at the mortgage rates just since September, really even November, up until now. Mortgage rates continue to climb. People cannot afford in Canada to refinance at these rates, which means homes are going for sale in the spring, and there might be a little bit of an uptick with action, but overall, home prices are going to get hit real hard in Canada simply because we're forced to renew our mortgage, and we have to do it at a higher rate. United States, you like lock in a mortgage for like 30 years. It's unbelievable. It's amazing. But in Canada, we just get slaughtered in terms of our shorter term mortgages.
One more point I should make this year in 2025, there's over 1 million mortgages coming up for renewal. So there's going to be a lot of pain. And that's why the Bank of Canada has been so aggressive here in 2024 in cutting rates because they're trying to get the rates down. They know there's this pending
Yeah.
problem on the horizon and they're trying to get in front of it, but I think it's too little too late. And so I got to ask you about gold. We talked about the US dollar, we talked about interest rates. And during these periods of uncertainty, myself, I always like to have an allocation toward gold. It did very well in 2024. I think it was the best year in 14 years.
Mm.
Um, where do you see gold going?
Yeah, so gold is still bullish. Gold is still in a strong uptrend. Now it has hit 100% measured move based on two major cycles. So the last super cycle, from the low to the high and down to this low, if we draw that out, Fibonacci shows, whoops, that we hit this level. And this was something I had talked about back in 2019 when we broke into this new bull market phase. I was able to say, hey, listen, the next major goal, upside target is going to be this 618 target, and it should pause, and then we should go up to that 100%. And so we've hit that on this monthly chart. And what's really interesting too, James, is if we look at the shorter one, this fresh news cycle to the rally up and this pullback, and we carry it forward, gold has also hit that 100% measured move. So it doesn't matter what half of this cycle you look at or which pattern, we have hit those levels. So I think there is a little bit of upside left in gold. We might see one more push, potentially to 3,050. So there is percentage wise, uh, potentially one blow off phase. And that's typically kind of what happens near the end of a move. You have a blow off phase, we could see a big spike up, and then it can get hit. And then I think we'll see it correct and pull back with the financial systems and all of that stuff, forced liquidation. And then there'll be an opportunity to get in for the next multi-year rally. It'll kind of be like buying back at, like, 2008, 2009 lows and having that 4 or 5 year rally to the upside. So I'm neutral to bullish on gold. It's hit both of its targets. We actually closed our gold position, and now we're moving elsewhere. We're going to let gold do its thing here and then reload during the next financial reset and get into gold miners and silver and that stuff.
I'm surprised how strong gold has been, even in the face of a strong US dollar. Typically, they move inversely, but the two have been moving together in the last year.
Yeah, when you look at gold, it's been up and to the right, and if I just flip to the dollar chart, it's pretty much been, well, not quite the same, more so recently in the last 6 months or so, up and to the right, both of them. So this is a warning sign. I mean, I think the whole world is liquidating. They're counting on the U.S. coming out ahead of the game, and then of course people moving to physical gold is get me out of the financial system. Our banks going bankrupt, or real estate going to pop, stocks going to burst, that bubble, and everything unwind. So people are trying to just get to cash, get to physical gold. It's why Bitcoin, I think, has done well. People are just trying to get away from the financial system because I think we're going to have a financial crash. And I mean, that's just how money flows. Money flows to where they think it's safest at any given time.
Yeah, and there's nothing better than gold in the hand.
Yeah, you're right.
So it sounds like 2025 is going to be a volatile year. I mean, the big issue is there's a lot of unknowns in terms of what sort of policies are going to be implemented in the next 100 days and what those policies are going to do to the economy and I guess also other countries like Canada, for example, and if there's going to be trade wars.
Yeah.
Trump has also said he wants to take over Greenland and Panama, so it sounds like it's going to be a very interesting year.
Mhm.
Well, I guess the other thing I should mention too, you mentioned the US dollar, you see it continuing going higher, but Trump wants a lower US dollar because he wants to bring everything back to the US and he wants
Yeah.
to make the US more competitive, but it's going to be tough to do that if the US dollar continues to move higher.
Yeah, easier said than done for sure. And I mean, this just goes like I see comments all the time. People are like, well, there's no way Trump's going to let interest rates go up. He's got real estate and he's not going to let the dollar go up. But the reality is, like, one person can't truly control the overall market. What's going to happen is going to happen. He might try to do some stuff, but the reality is the market really is so big. And when the momentum starts in a direction, you can't stop it. He can't just knock rates down and knock the dollar down just for his portfolio. It doesn't work that simple, really.
Well, that was a great discussion, Chris, and I want to thank you very much for spending time with us today. If somebody would like to learn more about you and your various services, where can they go?
Yeah, they can go to my website, which is thetechnicaltraders.com, or go to my YouTube channel and subscribe there at The Technical Traders. And um, I have a little comparison chart here of the strategy that I deploy. So what I offer at my service, which you can click at your link below here in your description, James, um, is this strategy called the ACS, which is the adaptive compounding strategy. It's this top line right here. We're actually keeping up with the NASDAQ since the 2008 market top. We have similar returns as the NASDAQ, which most people would kill to match that type of performance. And our max drawdowns, because we use ETFs and we rotate from one asset to the next, as one starts to stall out, we move into a different asset. You can see the difference in risk. The NASDAQ 50% downside versus ours less than 6%. So this is what I offer at my newsletter, which again, you can follow at your link that you've got below there for subscribers.
Yes, I will have a link in the show notes. Well, Chris, once again, thank you.
And thanks, James. It's always a pleasure. Take care.